Good morning, everyone. It's Friday. This week seems to have flown by again. Morning, Kate, and maybe Stel, if he's about.
Hello, morning. How are you?
Good morning, everybody. Good morning, Stel.
Ruben says you're out playing on the swings and roundabouts.
Close. Is there a lot of background noise here or not?
No.
Okay, good. You can't hear it. Okay, because there is some. All right.
Good stuff.
How are you doing?
Yeah. You're down the play park, aren't you?
Yeah.
Enjoying yourself? Someone pushing you on the swings? Because I know you're a bit short. You need someone to give you a push.
Oh, nice. Thank you.
It's Friday, mate.
It's the same. Being at the playground or trading markets, it's roughly the same. So
yeah,
I'll let you off. I'll let you off. It's a Friday.
Yeah, exactly. Well, plenty to get through this morning. Some important information dropping down from the data and stuff that we need to pay attention to. So we'll get right into that. I'm going to kick off with the Japanese CPI numbers, largely coming in as expected. The odd surprise coming in, though, on things like the food measures. We can see there national CPI coming in as expected, confirming a 1 pip drop. The national core coming in as expected and as prior. But what isn't printed on those numbers there is the numbers like the fresh food and energy, which came in at 3.8% versus 3.6 expected and a prior 3.5%. So the core number coming in much hotter, similarly to what we're seeing elsewhere around the globe with core inflation being sticky. So from my mind, there was enough in there for two things: A, for me to keep my dollar yen shorts on, and to suggest that inflation isn't yet going the way that the Bank of Japan said it would, i.e. they don't expect inflation to stay above 2% over the course of this year. The longer it does stay above 2%, the more the market is going to start getting a bit more hawkish over the BOJ. The greater the chance we get a bit of language change or wording change from the BOJ. That's my opinion. Kate, what do you make of that data?
Well, yeah, I mean, as you say, it's holding up. And the market is trading it, and probably rightfully so. Perhaps some people were already a bit short yen again due to Ueda and the other Bank of Japan members talking. But on the other hand, they also said that they expect inflation to drop back below the 2% second half of the fiscal year, which is like September, right? From September on. So yeah. I still think there's a lot of wishy-washy going on, but as you say, it's the fact is there that it's sticky. So the market will probably, as I said already, speculate a little bit, and we have to take that into account. And also, and I will show it a little later. I'll concentrate on the yen process perhaps today. Show those crosses where I said in the room earlier this week that we were getting to levels where it could be time for a bit of a change and or just reaching targets and see what happens. And it's in fact exactly what's going on. Since yesterday, we saw those yen crosses starting to top out. We also rejected the 135 around in the dollar yen, and we went back below the cloud. So there's a lot going for the yen right here and now. And I expect for this Friday for it to continue a little bit, you know. So yeah, it did have a decent impact on the yen overnight.
Yeah, exactly. And we'll switch to the US side definitely later when we get those flash S&P market PMIs for the US. Bit of a bigger set of numbers than the Philly Fed and the Empire and the regional stuff. So we'll get an idea. As we say, are they going to have a big reaction in the dollar? If those come in soft, we could see dollar yen maybe heading down towards that 133 handle. On the flip side, if it comes in good, we know what the data does. We could be up knocking against 135 again, or at least mid 134s. So lots in the mix for that pair, as we well know. Reuters sources speaking on the Bank of Japan, but nothing really of note, saying likely to maintain their ultra loose policy and make no change to interest rate targets and the yield allowance band at next week's meeting. So the fact that there's zero expectations going into this tells one story. It obviously, as we've been speaking about, the big risk, as always with these Bank of Japan meetings, is they do put out something that's seen hawkish, like another change to the YCC. So going in, we know where the balance of risks lies for where the bigger price action will be. Back to the data, and we did have here's PMI day as mentioned, and pretty similar story around the grounds on that front. Still seeing divergences between services and manufacturing around the globe. Manufacturing Australia still in contraction, but up a pip. Services whacking itself well into expansion now. So good run there on the services number. For Japan, also manufacturing still in contraction, services still doing better, but they came down a pip on last month. Coming down to the European stuff as well, same story. France worse on manufacturing, better on services. Germany worse on manufacturing, better on services. You get the picture coming in now. So that's been the theme all the way through. So service sectors doing okay in many countries, which we've been talking about in the chat room this morning. It's becoming a bigger sector than manufacturing for a lot of countries. You know, you take the UK, manufacturing only accounts for some 12 to 15% of GDP, hence why services is the number we always look at on that front. But what does this data tell us? Because there is sector divergence. It's a bit of a mixed picture, obviously. It means that not all parts of the economy are pulling in the same direction. But it also says, as services are quite a big component these days, it's showing that things aren't really that bad. We're not seeing any big, huge economic problems coming in, which has been the case for several months now, well, particularly latter part of last year into this year. Nothing's booming, nothing's going bust. So we trudge along, as they say, but these numbers are coming in pretty positive for the services side of things. Still, Kay, what do you make of the data overall? Same old, really, isn't it? There's nothing we should really be worrying about right now.
Not really, no. Funny enough, there's a pattern. Manufacturing is underperforming, services is overperforming, but no, nothing really to. It's not market moving, and nothing to make any deduction, let's say, from that. So I don't have anything to say, unfortunately.
Yeah, no worries. Kay?
Yeah, well, I don't know. If we take into account that, like, globally speaking, on the European, the big euro, not the eurozone, but the European continent, sterling, and UK included, manufacturing has come down a lot over the past decades or so. But and so overall, the numbers are good because of the services. But on the other hand, I'm kind of thinking whether it's really good, because for one, is it not going to keep one side of the inflation equation too high in the manufacturing sector? Is that perhaps what is weighing on that index as well? And also, and again, the services is a bigger deal, but those manufacturing, if they go down, it's not really a good thing either, because they are usually employing quite a few people, right? So I wouldn't completely dismiss it that the manufacturing sector is going down, but against that, of course, you've got a service sector which is booming, and yeah, that probably brings it back somewhere in the middle. If you look at the reaction in the market, for instance, sterling reacted 10 pips. Euro 20 as the PMIs came out. Euro dollar was in the 109.40s, and then went up into the 60s, and now we are sort of back in the middle. Yeah, so the market is I think scratching its head a little bit about those PMIs, or looking for other clues. That is what I take away from it, you see. And then, for instance, if you look at the Aussie PMI overnight, if we talk about all those PMIs, we had the same divergence, but then we had a big jump in those services, a real big jump, right? And then the Aussie still got smacked overnight for some reason. Well, I guess the end process have to do with it, but there's no real reason for selling aggressively Aussie on the back of that PMI, yet it happened. So yeah, I'm a bit in between two seats what to do with those PMIs today, really.
Yeah, I mean, I think the euro is indicative of what's happening in economies at the moment. I mean, we look at PMIs, we look at the data, and there's times we want the data to move markets, as whatever print comes out. If it's a big miss, a big hit, we might get a move we can trade. But for when you're trading fundamentals, it's all about what it means in the bigger picture. And what it means in the bigger picture, as we said, is that economies aren't going gangbusters, but neither are they collapsing. And while that happens and continues to happen, the fact that there's no worries in economies means that central banks can keep policy on the hawkish side. They can even move it further down to neutral as that continues throughout the rest of the year. But what it also means is that if there's no shocks coming into economies, you're going to get peace and calm. And when you get peace and calm, you're going to get lower volatility. When you get lower volatility, you get greater consolidation, you get less trends. That's how you build all the fundamentals into trading, looking at the bigger picture for them all. Because if you look at the data, UK in point, great services number. What else do we get? Absolutely crappy retail sales. So it's not all parts are pulling in the same direction. Some are looking weak, some are looking strong. Jobs market in the UK is looking particularly strong. Inflation is strong in the UK. Services is strong in the UK. Retail sales, not so much. Manufacturing, not so much. So, there's pluses and minuses, and there's cases they're all about even at the moment. And so when that happens, you're not going to expect markets to move massively one way or another until such time as that balance tips in the fundamentals one way or another, much better, much worse. When that happens, then you get the big changes again from the central banks and expectations. Then we go on a road trip with prices as well. So for now, I'm not expecting any big trends to pop up, not expecting any huge moves, lots of consolidation to come, decent ranges to trade, but volatility staying fairly benign, shall we say, unless we get any geopolitical shocks coming into the mix. And we've got to factor that in as we're trading it. That's the only thing we can do. But cracking on, RBNZ's Hawksby says the full impact of tightening is yet to be fully seen. There's early signs that growth is starting to slow. The extent of moderation will determine policy. Inflation is still too high and persistent. So a bit of a warning sign there for the economy in New Zealand, and maybe for policy if they see a bit of a faster slowdown. That will influence whether they keep hiking or go into pause or hike less. So that's on the Kiwi side there, and this obviously comes after their surprise hike of 50 pips. So further data may suggest they may move back to 25 or possibly even pause. We have to wait and see. BOE's Tenreiro said we may have already tightened too much. The arch dove over there at the Bank of England. No surprise there.
When is she leaving?
Sorry, go on.
When is she leaving? Because she's going to be replaced, right? When is she leaving?
I don't. It's usually they usually do it around August time. I'll have to have a look.
Oh, right, okay. Yeah, look it up. We'll look it up.
Yeah, we'll look it up. ECB, they released the minutes of their Monpole meeting, and a very large majority agreed with Chief Economist Lane's proposal to raise the rate by 50 basis points. They noted that more time was needed to fully assess the overall effects of monetary policy stance on financial conditions. Mum-Pole still had some way to go to bring inflation down, including in the case that the baseline of March projections materialised. Then it was reported that some ECB policymakers were worried that the new economic forecasts about wages growth and inflation were too benign, and that was even before they were published. That's been picked up by Reuters from those minutes. So some wanted or didn't think that the projections and the policy meeting showed that inflation could be stickier and wages could be stickier than the projections, and they wanted that put into those minutes there. So that would be the hawkish bunch of the crowd. ECB's Lagarde came out to say that monetary policy still has some way to go. ECB's de Guindos, core inflation may be more persistent than the market thought. There has been a whole load of other wafflers coming out, but nothing that it's worth boring you with. Same old from most of them. Coming back to the data, and again, here we go. We saw a pretty decent Empire State earlier in the week, and then we got the Philly Fed coming in with an absolute stinker, minus 31.3 versus minus 19.2 expected. Some of the components not looking too hot either, pretty much all showing negative numbers still. Employment wasn't as bad as expected, but still negative. New orders worse than expected, but a bit better than the month before. And that inflation number showing that prices are coming down in that one there. So again, a bit of a mixed batch in the details, but overall, we've had one decent manufacturing number and one poor manufacturing number. So again, it's 50-50. One time we're going one way, one time we're going the other. No trends developing. We also got the famous Eurozone economic sentiment, and things were a bit less crappier in the Eurozone by 1.6 pips on last month, but beat expectations, came in at minus 17.5 versus minus 18.5 prior. So things not as dour in the Eurozone if we're led to be believed. Back to the Fed, Mester said that she's happy with progress made so far, but inflation remains too high. Interest rates will need to move somewhat further into restrictive territory, but we're much closer to the end of the tightening journey than the beginning. Fed's Harker said some additional tightening is needed to deal with high inflation. Once rate hikes end, Fed will need to hold steady for a while. Expects to see tighter credit conditions on bank stresses. So pushing that line on the credit conditions. Also says the Fed is close to where it needs to be on rates. Just some of the geopolitical stuff. Bloomberg reported that G7 countries were perhaps going to move closer to a total ban on exports to Russia. At the moment, it's still a bit, some stuff is, some stuff isn't. Potentially now looking at banning everything exporting to Russia. Treasury Secretary Yellen said China's no limits partnership and support for Russia is a worrying indication. It is not serious about ending the war in Ukraine. A full US-China separation would be destabilizing for the world. China's increasing coercive actions are targeting US firms. Despite all that, still planning to visit China at an appropriate time. So really, when we're talking about the geopolitics, there's no easing of tensions at all coming in there. And for trading it, all it takes is one headline, one good headline that the US or China are going to talk or look to end some hostilities, and we get a big bounce in risk. So that's the main reason I keep an eye on these headlines to see if there's any change in sentiment. And for all you crypto nuts, you're all going to get regulated if you're in Europe, because the EU Parliament has backed the world's first comprehensive rules for crypto assets. Everyone cheer. That's likely to be voted in mid-2024. It will require firms that issue and trade crypto assets to be licensed by a national regulator. which will give them a passport to serve customers across the 27 member states. Major service providers will have to disclose their energy consumption. So if you're trading cryptos, look for rules coming your way soon. Stel, you're probably our closest crypto nut.
What?
Probably only one of the few actually looks at what's happening in cryptos. Par for the course, really, got to be expected. We've been waiting for regulations to come in, and here they come.
Yeah, it's the danger that I'm seeing now, and apologize if there's background noise. Big danger is that we got a breakout in Bitcoin above 29.2, and that's just been reversed now. So that's bad news, because if it is a false breakout, then we're going to be heading back towards 24K or something like that. So it is. What's your timeline now? Go to a daily. Let's say that's a lot better. Yeah.
Oh, no, it's not. It's even worse. There we go.
So yeah. So you see, we had those highs in. And we had those highs in March, end of March, and we broke above. And no, the other ones, yeah, there you go. We broke above that, and that should have been a clear signal for a new bullish leg. But now, we're talking about regulation, talking about lots of stuff, and it's just got, the breakout got cancelled basically. So. Dangerous situation. I wouldn't want to be long here. I thought buying the breakout was good trade, but obviously you cannot predict what's going to happen with headlines, with stuff. And to be honest, risk is still doing okay. The S&P has not broken down below that 41.10, 41.15 really critical area. So as long as that's the case, and we are still in kind of buy the dip mode in risk, theoretically cryptos should also be doing well, but and I write this on my macro analysis for those of you who are subscribers on ForexAnalytix. I write that one of the dangers for crypto prices is regulation, because eventually the governments are going to want a piece of that action, right? It's now $1 trillion market cap instrument, cryptos. So they're going to want some part of that. They're going to want to regulate it, obviously get some taxes paid as well on that. And so that's the danger. And are we seeing the beginning of that? Maybe, I don't know. Yeah.
Still, your mate Michael Saylor. I saw somewhere when Bitcoin was trading around 30K, that his average must be somewhere around 29.2, 29.5.
Yeah.
Perhaps he's been leaning on it a little bit, seeing finally his average back. I don't know, but I think it's not completely random that we capped just above his average, because everybody's looking at him, right?
Yeah. Saylor is tricky to understand where his pain threshold is, because he's bought loads of Bitcoin for his company, but that's
he's on his clients.
Yeah, it's difficult to gauge where his pain point is, but anyway, I don't think it's close. But yeah, what can I say?
I think you said it all, mate. I think you said it all. Kay, you got anything you've picked out the millions of lines that cross our screens?
No, really, mate. I mean, it's a lot. So many people have been cheating and chatting, and I don't think, apart from what we discussed, that there is anything. We know about the geopolitical situation. Yellen, if ever she goes to China, I don't expect more than I don't think that she and G will really do anything more than some chit chat, talking one next to the other instead of talking one to the other, I reckon. But no, for the rest, I think it's let's watch the data and see if we can come out with something reasonable.
Yeah, but for those of you guys and girls who are in the chat room and perhaps haven't seen yet, I put up a couple of worrying articles yesterday. There was one about the UK labour market, which obviously was looking pretty good this week, and it was saying that perhaps underneath it isn't as fine and dandy as being made out. There's been a bit of disparity between the jobs growth and that it's all going into the public sector, which is things like the NHS and government and that sort of thing. and actually jobs have been falling quite significantly in the private sector. Now that's important for the UK because it's the private sector that pretty much holds up the rest of it. So if the ratio is switching from private sector jobs and wages growth to public sector, that's going to be bad news for the UK, because it can't keep the rest afloat. It is the private sector that keeps everything up and running. And if that's facing problems, we're going to get bigger problems for the economy than we might be thinking. And another one was that there's new regulations coming into Europe, to the US, and credit references and stuff, that apparently if you've got a good credit score in the US, you're going to pay more for your borrowing for things like mortgages, as a sort of stealth tax on those that don't have good credit ratings and are more risky. That didn't get good fanfare from some of the crowd in the US side in our chat room yesterday. But again, a very worrying story, because why would you bother getting good credit scores if you're going to pay more than someone who's got worse credit scores? Bit of a bonkers headline in my mind.
The question is, how do you get a bad or a good credit score? By paying everything, right? Like you have a credit card, you pay everything straight away.
Yep.
Banks make money from people who don't pay everything straight away, right? They charge 17-18% APR on credit cards and all that. So this is just another way to tax people who are diligent and make them become less diligent, which means make them spend more on things they shouldn't be spending.
Yeah, but then
it's crap.
Exactly, but then you make the people who have been diligent become less diligent, because they think, why bother? I might as well be a bad creditor and get cheaper rates, and I can still afford it. I don't understand it. It's a worrying direction to be heading in, and they're not the only country to be doing that. But I'm not trying to make this a political football or anything like that. But that sort of thing can impact the housing market, and then that can impact jobs and wages, and it all travels down the line, and we get problems. So just keep an eye on things like that. But anyway, as I say, not making a political football out of it, just pointing it out from what possible ramifications we may see from that. Right, so let's have a quick look at what's going on in markets. I'm really glad my short from 135 got knocked out, or partially knocked out, on my trailer at 134.85 the other day, because it's been south ever since. We did get another run up to that 134.95 area, but we are heading south. We're in a bit of a level at the moment. This old fib 133.80, call it. There's a bit of traffic here, maybe down to 60, maybe down to 50, but certainly around this 70-80 zone. As you can see, it was where the former highs were when we got up to 134s before we had the move up to 135s, and so it's sticking around here. If it gets a move under here, as I say, it might be the data that pushes it later on from the US. We could get a move down to 133. We know the data has been quite volatile for the dollar and yields, if there's big variations. So we could go either way here. I don't know if even decent numbers push us that high. I'll be looking at this area here if we do get good numbers from the US. But maybe if we start getting up here, some BOJ traders will be thinking, right, based on the CPI, we want to get in a few more shorts up here. And so I'm expecting that to be a traffic zone once again. But for me, it's a bit two-way. Kay, what are your thoughts on the yen here as well?
Yeah. I mean, it's two-way for one, but if you look at the yen process, they are really, really very, very heavy. And I reckon that's at least what the European market does. Now, then for the dollar yen, we perhaps may have to wait for the US session to really make a direction globally on the dollar, on the PMIs. But so I won't show it anymore. The daily cloud comes in today, the top at 134.30. We had a close above the day before yesterday, and it traded around there for a while, but then finally gave up, and then the CPI confirmed it. And so 134.30 today. I reckon if any Any move seen back up there on the US CPIs? I think for today we'll find sellers up there in the dollar yen, but I think the yen crosses are perhaps a bit more interesting. But yeah, at least I expect 134.30 to cap today on the dollar yen. Let's put it that way.
Yep, we're in agreement, mate. Dollar yen is a bit on the yield bus this morning, as you can see there. Although yields are nicking a new low, dollar yen isn't really following as yet, but it has pretty much seen everything put in the same way this morning. Oh, wrong one. 10-year yields. That's looking more like. Let's put that there and go back there. See what happens when you try and get clever, Ryan, with your charts. So yeah, you can see 10-year yields pretty much mirroring what dollar yen's doing, or dollar yen mirroring what yields are doing at the moment. So we're on that bus, hence why we should be looking at the US side of things this afternoon more so than the yen side of things. But okay, we'll have a look at the little old crosses in a moment. Let's just put that onto the big chart. Cable and look at the old mate 124.50. We had all this wishy-washy about yesterday, and then wallop, it's resistance again, and wallop, retail sales, and we're down again. Walking from pillar to post pretty much in this one, down towards 123.5 is probably going to be the number down here that we need to keep an eye on. If we get under that, then probably 123 not soon after, but that's looking probably like an area where we may find support with nothing better to do elsewhere. Euro sterling, it's having a little move up again today. I think again this is probably more on the retail sales side for the UK, and the pound moving more than the euro. One day we get good data, one day we get bad data, and thus we're up and down, but still sitting in that range right now. I might even nick a bit off my 88 longs that I've been moaning about while Kay does his little look around in a moment. Aussie dollar sitting on pretty decent support down here, bit of a zone, 60s, 80s. Another one of these sort of always does something when we get in here type thing. You know, it's resistance, it's support, it's resistance, it's support. Well, we're down here again. We had a test previously earlier this week, and that took us a bounce all the way back up. Well, we're having another test again now. I don't often like it when prices come back too quickly, but as you can see, a lot of action down here. So only if we get through this zone, perhaps we're looking at something more, maybe something down to the low 66s from there on. Dollar one, again, it's just looking a bit peaky, moving like it wants to go up more than it wants to go down at the moment, but not even getting fairly close to the recent highs. So no real conviction in that move, but maybe I might start to look for a potential break trade at this level. If we knock our head on it enough times but keep coming back here, that will suggest that if we do get a break, we might get a half decent move through it, maybe up towards 694, 695s, up to this sort of area here perhaps. I wouldn't be expecting any rockets unless it's a big driver behind it, but purely on a technical basis, if we do suddenly break here, we might have some legs in it. Apart from that, not an awful lot been going on for me this week. It's a bit hard to trade markets that are going nowhere, and I'm not a good scalper by any way, shape or form. It's just not my bag of tricks. Kay, do you want to get into those yen crosses, mate?
Hi.
Before you do,
Yeah.
just want to make one note.
It's the swing trader.
I had I wrote in the chat room, I had placed a stop for that last little long. I had that last third position long. I took at 24.60 something. I placed a stop at 24.98 to go taken out today, still in profit. And then, of course, it went right up, back up above 25. But anyway, so I'm still running 2/3 of the position from way below, and I'm still trying to be nimble as much as I can. I'm not excluding the possibility of another dip, so I'm trying to be a little bit cautious That's it. I actually have to jump, so I will see you, our clients, and you guys, Ryan and Kay, in the chat room. For everybody else, have a great weekend.
Yeah,
Thanks,
cheers, mate. See you in a bit.
Thanks, guys.
Over to you, Mr. K-Man.
Jawohl. So first of all, in my opinion, the most difficult one to trade, and that's the euro yen. Although, as I will show on other yen pairs, it's also capped now. We tried a couple of times to go above the extension here and above those prior highs. It was a quick try, but we're running out of steam, and that's due to the yen side of this pair. It's lower, yes, and we are back below the December high, so that's already going to be a good marker for the close tonight. I think 146. Call it 3/4. Above or below is going to be likely to be a very good indicator. If it stays below, there's a possibility for these to trade back into the mid 145s at least, and then trade again along this last break line. It's possible if there's more speculation on the yen around 144.5. But again, it's looking at the euro's behavior on the cross side. Unless we start to really reverse in euro crosses, it's probably not the simplest one to trade that euro yen. What is much more clear is the antipodians and the commodity currency versus the yen. This is those are really being a big mover. And I showed this. I don't know if I showed them on here, but for sure in the room over the past few days, and saying like, well, look, we are at levels here where this is starting to look worth the reflection. And then we had the rejection of the 135 in the dollar yen, and then the antipodian started to weaken again. Once more, I don't know really why the Aussie got really hit on the head, but I do think it's more to do with the Aussie yen than really Aussie weaknesses as such. But anyway, this was like a really good rejection, and we are already trading at even a little bit below now the 50% of this down move that we saw, which had an impact on had an importance on the way up, and now we are trying to go below, which in turn is keeping again a lid on the Aussie dollar. So those ones are really those rejections here. They have to be monitored very closely, and I think as well, even looking forward into the Bank of Japan next week, if we would have all else equal, if we would like to start to stall here, but I think this afternoon it might be a bit of a bloody Friday for yen crosses. But even let's say if we stall here and we go back on the BOJ, if you start to see it in those levels here, even on a BOJ that keeps their hands still, but then depending on their wording, if we ever get back into this zone, I think it's really worth to very closely monitor that level, because it's been also levels traded in the past, so keep a very close eye on. For the time being, they are really rejecting, and pretty hard, because this move was relatively, let's say, orderly, impulsive, thorough, that we saw over the past 2 weeks, and now we are seeing, which is a bit typical about yen crosses. If you look at it over the past as well, the moves lower are usually more faster than build-ups for moves higher, because that is people buy, and the model funds buy, and fundamentals can buy it because of the divergence in interest rate, but then everybody wants to get out at the same time, and this is again what's happening now. So I really expect yen crosses today to be on the defensive. And finally, Kiwi yen, which was holding up very well, we had a bit the same thing. It's a different picture, but it's the same thing. We tried, broke higher, but failed. We tried, broke higher on Wednesday, Thursday, but then failed again around the past highs, and now we are already back trading those supports. We broke through 82.25, and we're already very close to the next one, around 81.75, 81.70 or so. So keep a close eye on those ones, because all those yen crosses are showing more or less the same thing. Look at the Canada yen, another one that I was showing in the room earlier this week. We had this upward channel, or you call it as you wish, on the shorter term, but it held, it kept along the trend line. We tried of the prior tops. We tried to break above the channel, had already a bit of this activity around this trend line, failed again, bang, we went down pretty sharply. Also helped with the lower oil prices, because as we know, yen being an importer of energy, when the oil prices go lower, that also should put a little bit of upward pressure on the yen. So you have the combination here as well in the Canada yen. We are turning around levels that have been traded actively in the past, a bit of crossroads, traffic islands, and so keep an eye on this Canada yen, 99 figure 10. If we stay below, then there's likely going to be a chance to go 100, why not even 200 points, 200 points lower if the market wants to go and retest this zone here. So keep a close eye on the 99.10. Again, this afternoon we have retail sales out of Canada, but again, they are February numbers, so I'm not 100% sure if that's going to have a long-lasting impact. But the Canadian dollar is still under some pressure as well. I'll have a look at the Euro Canada and the dollar CAD. But this one, I'd say 99 figure 10. If we get a spike again, I'd say that anywhere around 99.5, I'd expect already some decent resistance in this cross. And again, this is all in the context of as well looking at what's going to happen a week forward from now at the Bank of Japan, which as Ryan was talking about, as we were talking about those CPIs earlier today, there is, and I said it as well in the room or on here, there is, I expect, going to be some more speculation about what the Bank of Japan possibly could say, more than anything else, or because I don't expect them to really do something on the first meeting, but at least what they could say. So, and that's going to have an impact on market. So I wouldn't rule out more speculation into next week. So I'd say we are going to find now rally sellers in those yen crosses. I'd say. So those for the main ones. And then, yeah, Unit was asking which is the best yen cross to sell. That's a very personal, everyone's got a personal opinion on that. I'd say look at how the antipodians react, because the, and one in particular, and I'm going to talk my book a little bit there as well, is the failure of the Kiwi to react to what the RBNZ said. And we, or did, they raised 50 BPs and the market took it as, okay, this is the last one. And then we saw a lower CPI coming out earlier this week, and they, and the Kiwi really has trouble, even on the Kiwi dollar, it has trouble to regain some strength. So I'd look at that side, or perhaps if the oils continue to go down, perhaps a Canada yen or so. That's a possibility. But I'm not saying that those are going to be the best. Those are just the ones that seem the most on the defensive right now. Sterling yen, absolutely no exception to what happened in the rest of the yen pairs, and I also showed this one. There was a risk or a chance or whatever for those who were long to get up into those 168, 169 zone, but we went above this wedge trend line and failed. And again, and we are already below this, and we are already trading on the next levels of bit of support around here in the 165 3/4 zone. it's just the same thing. It's one big yen trade. Okay. I don't know if you're bearish sterling. This could be one, because the cable is also starting to reject. Euro sterling had a very big rejection sub 88. I really thought and I've been saying that the sterling would have a little bit more strength in it, and really I'm been really lucky to not have really dived in a lot more into sterling. I had a few decent nibbles long sterling, but the last one on the euro sterling, really I thought we would have a crack back below here, but it didn't really materialize, and now we're already back to the resistance line of this. It's either a channel or a triangle, the way you want to look at it, but we are at the resistance, and I wouldn't rule out a test here to this 88.65 again for a starter. Yes, sterling is a little bit disappointing. So if you really are bearish sterling, then this one, the sterling yen could be your poison as well. If we get back to this broken trend line here around 166.65, a bit like the rest of the yen crosses on any retracements, that may already be enough for today. So keep an eye on 166.65. Other side, low 165s, and then we are talking about every 50-60 points you're going to find levels. The major one here could be around, but that's already a while away. That's about 1% lower from here. 163.75. That's going to be an interesting one, I think. That for the yen pairs. Euro dollar, I'm not even looking at it. Cable, Ryan already did it. 124.40.50, obliged traffic island there, and it rejected again. Let me just look at the questions. Is it sensible? Horatio. Okay, Horatio. With the strong jobs report in the UK and the beating CPI earlier this week, will the missing retail sales today, does this bring fears of economy and any stagflation? I really think that still the global economies are more working in tandem with each other. Okay, the sterling could be, as we see today, have bouts of weakness, but calling for stagflation, I don't know if it can be because we are going to have difficulties to see big GDP growth in any economy this year by the looks of things. People already crying victory not to have too deep recessions eventually, but yeah, stagflation is a possibility, and that is a very bad thing for a currency, right? Your next question is short to short euro yen at the market on a break below the 200-hour moving average. That's not a question I can answer for you, because I'm not looking at moving averages on anything below daily or even max 4 hours. So I don't know. I don't really know on the hourly MAs. Really don't know. I want to look at some dollars. This Aussie was kind of firm in its range, but then the short-term support all of a sudden broke there. There's a bit of dollar strength in non-euro or non-yen or non-Swiss pairs, and perhaps it went down in sympathy with what was happening on the Kiwi as well, but we are scratching a little bit our head why specifically the Aussie came down. I really think it's more down to the yen strength this time than to Aussie dollar weakness. So keep an eye on what's happening for the rest of the day at 67 figure 10, and then back at what's happening at 67.5. And on the downside, it's roughly the same. It's 66.55-ish. That's where we need to watch out for what's going to happen after the US CPIs. Kiwi is one I'm in. And as we know, the 61.90 figure is your 124.40.50 in the cable. And so yesterday we broke below, we tested it again, probably knocked out a couple of really weak stops there, but finally it did cap. I like still the short side on this one, especially that we're already below 61, 45, 50. That's a bit of a small level, but the prior low here as well. Could stall here for a while, and then we wait for what's going to happen on the US PMIs. If though we get a close below these prior bottoms, then we are likely going to see a move down to those prior lows just below the 61. There's going to be interest here if ever it gets down to this 60, 65, 70 zone. There's going to be an interesting watch on the Kiwi, really. If ever we see down there top side, well, it's clear, 61.90 figure again, and then above there 62.30. There's a bit of a trend line here, but it's a weak one right now. I do think if ever it goes back above 62.30, we are going to see some short-term shorts run for the exit, yours truly included. Canada. Dollar CAD is pretty close to the prior highs here, a bit of a high here as well. Seeing those lows here as well. So keep an eye on what's happening this afternoon, 135.5, I'd say. And then probably we are looking at 135.80, 136, the figure beyond there. If we get a close below 135, then we're going to have to look at again around the 134, 2030s where it was hesitant. And I think to me, the main zone here is 133.90 figure. If it goes back below 133.90 figure dollar CAD, then I think the party may be over and we should be in for a retest of the 133 at least. Right, quickie on, and I'm looking at the clock, quickie on gold and silver. Yesterday we saw this test in the 1970s, as I was saying in the room, that was possible. Had a quick look below this trend line, but then it's you have to give and take a few bucks in those metals. It's not really how shall I say, down to the pip or down to the tick or however you may call it. But this zone in the 1970s seems to be important enough right now. So we are going to keep an eye on that zone again. Top end 2015, and then we're talking again about 2030s. PMIs this afternoon will have to diverge a lot from what we are expecting now and what we are actually seeing in the prior PMIs in Europe and stuff to really get the dollar going, in my opinion. But we never know. I mean, divergences with expectations are going to drive it since we are Friday as well. Silver, pretty cool. Pretty cool moves. Again, Stelio's already talking about this, picked it up. I let some of it go and folded the rest in my long-term position around this 25.30 yesterday. It's turning around 25. I don't know. It's either going to go back down to this 24, 40, 65 zone, or we're going to have a look again at mid to high 25s. I doubt that today we'll see a break of this 26, 10, 20. But okay, this is going to be the next big zone, in my opinion, to watch. If it goes above there, then we're going to be doing another buck, I reckon. And the last couple of things, impressive Euro Noki. There's no other word. Noki really got slaughtered over the course of this month. We're 4%, 4.5% higher in the Euro Noki after this 11.20 held. Yes, the oils have come down again, but it didn't even benefit really from the OPEC oil output cuts, and it's now earlier than I thought and earlier than I was hoping for, already coming into this very close to this reflection zone in the 1170s. I'm going to have a very close look at it because I don't know what justifies, unless oils or gas continues to crap out further. I don't really know what really is going to justify a lasting move above this zone. I'm either going to watch it on the euro or on the dollars. The dollars a lot less impressive, of course, because we have the euro-dollar impact in the meantime. But yet, broken and really held well. Here, the next zone is also somewhere in the 1070s. If it has to go there, I really hope or if it has to overshoot, I really hope it's going to be a lot closer to month end next week, because we can see here, and let me pull up the daily. We can see here we are already above that, well, no, we are turning around. Sorry, and that was our those overshoots here and those highs here. Also there, it's very close to those levels, right? Where we those were the pre-pandemic highs, and really fundamentally, I'm starting to have a bit of an issue to see what should or why it would really go a lot weaker, this Norwegian kroner. Yeah, and then just a quick look. Dollar rand again and again and again, testing 18 and holding. It's just simple. For those who want to trade it, if you want to trade against it, you have this trend line here. If it goes below 1794.95, it's also this fib here. If it goes below there, I reckon that we have a fair chance of seeing those lows again. Thank you, Geir. Geir saying Norway needs to start to be funded by loan like all other countries. So and that you think is the weakness that is explained right here and now in the Norway, or the accelerated weakness according to you? I need to look that up. That's an interesting point you raised there. So that's for the dollar Canada, and then yeah, the rest is yuan already shown. Yeah, dollar makes not a lot to say, turning around those this 18 as well. If it breaks below 1790, we're probably going to go lower. For the rest, we're in a range. And with that, Mr. Ryan, I'm going to pass it back to you.
Thank you, mate. Well, just quickly before we shut up shop, I'm just going to look. Ionut was looking at Aussie, Swiss, and CAD Swiss, not ones that I trade a lot. And the question was, can the trend continue, and what will turn it around? Well, first and foremost, I'm not hot on watching the fundamentals between the two. So it's purely looking at price action. You see my screen all right, mate?
Yes, we do, right.
Yeah, cool. So, okay, can the trend continue? Yes, the trend can continue. What does the trend need to do to continue? It needs to break levels. It doesn't matter how you want to trade it, whether you look at fundamentals or what. If you're trading big trends, the price action will give you clues. Okay, here was a clue in, let's look at CAD Swiss. We came down, we found a bit of a bottom, got some bounces, bit of up and down, bit of up and down. Then we broke it. Then we found that area as resistance again. So that tells you the break is confirming. Now we're doing the similar here. We've had a low, we're coming down, we're testing that low. We will either bounce from that low, or we'll continue breaking through. And then perhaps you get a similar pattern where we break this low, it moves up, it becomes resistance. So if you want to trade trends, you look for the clues that give you the way that the market's moving. If it wants to continue going down, it's going to make lows, it's going to break those lows, it's going to confirm those lows. If we find a bottom here against this low, that tells you the market's had enough for now. What does it need to do to change the trend? Well, first instance, it needs to get above this area. If it can't get above this area, well, then there's a bit of indecision. It doesn't know whether it wants to go up or down. You look for a break either side. If it gets above here, confirms it by coming down, testing it, and then bouncing on, then you know you've got something more on. You've got a stronger bottom in play. Similar picture over here on Aussie Swiss. We've just been trying to break this low, but we're not quite breaking this low at the moment. But we can't get above this break point. So until we move one way or another, we're either going to continue the trend, or we're perhaps going to break the trend. And then what you do is you bring in your fibs, If it's been a big trend, you bring in your Fibonacci's to judge. Okay, so just as an example, let's slap one on here, just roughly. So you've got all this small price action here. If you want to break this trend, fine, we've got to get above this level. But to really break this trend, you've got to start taking out these fib levels. You don't take out these fib levels, then it keeps the trend in play. It's a similar thing that we've been watching through dollar yen, through all cable, euro dollar. A lot of these moves, we've seen strong trending moves. Even if they're short-term moves, we're not getting down to the fibs. We may be correcting, pulling back, but we're not getting down to the fibs. So it's gauging the trends in different stages. You've got the short term, how you can play it right here in the short term action. Then you've got the longer term. If you're going back up, can you get up to these fib levels? And can you break these fib levels? Get above the 50, the trend is changing. And if you've seen the clues already down here, then you're riding that train up there. Okay, and this is where you'd be looking to take profit, because the old, if we don't get above that level, what are you going to do? Take some money off the table. So I hope that answers your question, Iron Nut. It doesn't matter what the fundamentals are. It doesn't matter what's going on in the markets. You can just trade the price action. 60 level is a psychological level. Yeah, very much so. Very much so. Got to look at those levels, and we're holding, give or take, there at the moment. But the price is going to do one thing or other. It can only do one thing or another. Either go up or it can go down. The question is, what are you going to do with it? Here's the technical clues to help you make that judgment if you so wish. And it doesn't matter what your bias is. You just go with the price action. Anyway, that was a little lesson to end Friday with. Thank you very much, K-Man, for all your input. And I'll say a big thank you to Stel when I see him, if he's not fallen off the roundabout, the play park.
He's likely out snorkeling now.
Yeah, exactly. And
good weekend, everybody. Thank you for being with us all the time. And don't forget, when we put up the videos, to like us, retweet, do whatever you like, but do a bit of promotion so we can have more of you in here and have more fun.
Yeah, definitely. Well said, mate. Thank you to all the viewers. Have a great weekend. Have a great rest of the day. We'll see you next week. Have a good one.
Oh, Ryan, put on the Twitter handle. Ali is asking.
I put it out there yesterday. Oh, here we go.
The ForexAnalytix and perhaps Forex Flow Twitter handles.
There we go. That's the Twitter handles. At Forex Flow Live, at ForexAnalytix, and from there you can find K-Man. Do you want to put yours up, mate, while you're there?
Yeah, why not? I have to find it back first. I don't even know my own. I promise I don't know. Yeah.
You'll be able to find it. Kay's always retweeting stuff, and you'll find Stelios, Blake. You'll find all of us on there. There he goes. He's found that it's his own name. Well done, mate. Right, you got it now. Have a great weekend, everybody.